Hi, and welcome back. In today's lesson, we're going to discuss stock investing. Now, becoming knowledgeable of stock investing and understanding how your stocks move can help us directly with our options trading. And I'll show you how in just a moment. All right, now a novice options trader might be wondering, why on earth are we talking about stock investing? Well, remember, every portfolio should begin with some core holdings of good, solid, strong, fundamentally sound companies that you can feel comfortable about owning, not just for the short term, but for the long term as well. In fact, remember, options trading can involve different amounts of risk. And let's keep in mind that these are timed investments that should only be done with a smaller part of your overall portfolio. In other words, if you're using money that you cannot live without, you may not want to use it for options trading. But there are other huge benefits. In fact, Charles suggests himself that owning great businesses is the way to building wealth. When you read any list of the richest people, all are based on ownership in great businesses. Why aren't you then an owner of these businesses? So some of the benefits are that they provide higher returns compared to other alternatives like bonds, bank accounts, and CDs. In fact, in today's day and age, if you have your investments just sitting in a bank account, you're technically losing money because of the negative detrimental effects that we have from inflation. But options provide also the ability to potentially generate income through the dividends. Some stocks pay out a quarterly or even a monthly dividend that can help supplement your income. Stock investing also provides the ability to diversify a portfolio across many different sectors and industries. By spreading that out, we actually balance out our risk when one sector is rising up and the other one's going down. We also have the ability to own part of a company whose products or services that are used and liked. So take those stocks, those companies that you use their products and services, and maybe start there. From an options perspective, though, it's important to first invest in stocks to become familiar with how those stocks move. Remember, stocks can go up, they can go sideways, they can even go down. We want to then tailor make our option strategies towards what that stock is doing. Understanding how stocks move, both over the short and long-term timeframes, will help us choose then the option strategy that's best suited for the stock at that time. All right, well, how do we begin then? We'll start with what you know. Take things that you use in everyday life. I tell my students to also take things that you observe. What are other people using? When you go shopping, what types of products are people buying and being sold out of? Start with what your level of expertise. I talked with the rocket scientist the other day. He knew everything about the aerospace industry, more certainly than I ever did. And so he used those stocks that are in that particular group for his investing. Also observe what's going on with societal trends and societal events. What is the next big thing that you hear about? And then create a watch list of those stocks. What we'll do when we have stocks for investments, primarily our objective is more for buy and hold, holding on for the longer term. So we want to look at things from a fundamental perspective. Specifically, just as a beginning point, we can check to see if does the company have a good track record? Have they had a past of having good earnings, beating their expectations on a quarterly basis? Have they been able to do better quarter after quarter and having positive surprises? But also we want to know, how well is the company poised to do for the future? What are analysts anticipating and expecting for the company for future growth? And there are many ways you can do that. Just as one point, let me share with you my desktop, is that you can bring up sites like your own brokerage firm or other free sites like, for example, Yahoo Finance. I'll just type it in here, where it provides a lot of information regarding stocks. And so I could take any company, for example, what I'll use today is some company called Pool, symbol POOL. As you might surmise, they deal with swimming pools. And this provides a lot of financial information. But what I can do is go to this analysis tab in Yahoo Finance and be able to see things like their earnings history. For example, I can see that this particular company over the last 4 quarters has consistently done better than what the analysts had anticipated. In other words, these are the positive surprises that the company has had, beating what the analysts had estimated in terms of their earnings by wider and wider margins. That's a very positive sign. But also I can see what are analysts anticipating for the future and if they had upward revisions. In other words, just 3 months ago, analysts were anticipating that this company was going to have roughly around $9.50 of earnings for this year. But now they've revised that to be even higher, nearly 12.5 cents per earnings. For next year, even more importantly, they're anticipated to have about $10.50 of earnings. Look at that, they've grown by maybe 30%. So that bodes well for the company. It would suggest that this stock is perhaps a good growth stock. As we can see from some of their estimates down below, they've got some very positive numbers for what they're anticipating with their growth. Well, that's a good thing for someone who wants to buy and hold on to a good, solid company, not just again for the short term, but for the long term as well. By the way, if you're a subscriber to Charles Payne's hotline service, he does all that heavy lifting for us, where he'll research and analyze these stocks from a fundamental perspective and then send out alerts letting us know of these good companies that we can buy and hold on to. Okay, well, that's great for our core investments, for our holdings that we may have. But the question to ask is, when we're trading options, is that really for the longer term? Well, while it's true we can certainly buy options that have expirations out way even past a year or two, for the most part, options are treated as more of a shorter term investment. And the reason why is because there's always an expiration. It will one day no longer exist. Because of that, then we have a different weighting that we approach towards our options trading. For example, when we're buying and holding on to stocks, yeah, we may spend more time looking at the fundamentals, but when we're trading options for more of a shorter term type of trade, our emphasis will be more on the technical side, looking at those charts and graphs and recognizing different signals and different patterns and tendencies that those stocks will have. Okay, so what we want to do then is create watch lists of stocks that meet our objectives. We want to, in fact, I'll just show you. Let me share it through my desktop and go into our Thinkorswim platform. Remember, this is just a software that we use through TD Ameritrade. It's free and available for everyone. This is not an endorsement of their software. You're welcome to use any site that you'd like. This is just a paper money account that I use for teaching and trading, but for also monitoring my own stocks that I'm looking at. So for example, I may create a watch list of stocks that are being very bullish, that are rising up in value. Here we go. As I look through these, you'll notice as I'm scrolling through and looking at these charts, that most, if not every one of these stocks are in some sort of strong upward trend. They're being bullish, they're rising up higher. So they may be candidates for bullish option strategies. Things like buying calls, either for the short-term swing trade, maybe even a long-term trend trade. Possibly you might even use some of these for selling cash secured puts, an income strategy that you'll learn about. Okay, but at the same time, you may also have a watch list of perhaps very bearish stocks, stocks that are moving lower. And so as I look at some of these, you'll notice that most, if not every one of these stocks have been falling down, which might provide good opportunities for trading to the downside using option strategies like buying put options, for example. Okay, but there are some commonalities, some very specific things that we'll want to be looking for. The first would be, let's make sure that when we're trading options that we choose stocks that are already very actively traded in liquid. By the word liquid, we mean that they have lots of volume. Generally, we want to have stocks that have at least 500,000, maybe even 1 million shares or more traded in average daily volume. Why? Because if there's a lot of volume traded on the stock, most of the time, not always, but most of the time, that'll mean that the options may also have a lot of volume trading as well. Why is that important? Well, after finding stocks that are trending in the directions we want to have options that have plenty of activity, meaning they have plenty of what's called open interest. Think of open interest as the amount of contracts that are currently being held and open that aren't exercised. If we don't have a lot of open interest because we don't have a lot of volume on the stock, that generally means that we have much wider spreads. In fact, let's make an observation here. If I were to go in back to our website here, and I don't know, let's look at maybe a company like AVY. Not a bad looking trend, but I'll notice that it doesn't really trade a huge amount of volume. There's only about 500,000 shares traded daily. As I go to the trade tab, when we trade stocks, you might remember that we have two prices, our bid and ask price. And there's a bit of a spread in between that. Not too bad, 11 cents, I guess, here. But because it is kind of a low volume stock and wider spreads on the stock prices, when you go to trade options, it's the same thing. Look at our bid and ask prices. Notice here, this column would be my open interest column, where we have very little and sometimes even just zero activity in those options. What does that mean to you and me? Well, when I go in to look at the trade here, look at some of the spreads between that bid price and asking price. My goodness, if I bought this particular call option at $17 and then decided I wanted to quickly turn around and sell it right now, I've already lost nearly $3. That's over a 10% or 20% width there, even larger than that, quite frankly. take one more stock. Maybe if we look at a company like GL. Notice again, not a lot of heavy volume on the stock, not a lot of open interest in this column here. And so when you start looking at some of these options, they get wider and wider. And that's a negative, that's detrimental to us when we're trying to buy. So our objective is to try to have much tighter spreads. In fact, just to show you comparison, if I brought up a company like maybe Microsoft or Apple, of course, we know about Apple, they've got plenty of volume traded daily, just a penny wide spread on the stock prices between the bid and ask price. But also notice, look at all that open interest in the thousands even, incredible. Look how that translates to much tighter spreads in between our bid and ask price, maybe only just a few pennies wide. And that's what we're after. We want fair pricing. So by having strong volume in the stock and trending in the direction that we'd like for the particular strategy that we're choosing, we want to make sure that we have plenty of open interest, which would mean that we should also have options that have tight spreads between the bid and ask prices. One benchmark that we could use would be try to shoot for having no greater than a 10% width between that bid and ask price. For example, if our bid price is showing $5, 10% higher than that is 50 cents. So we'd want to make sure that our asking price is no greater than $5.50, or at least in that ballpark. By the way, you'll have very specific rules and criteria in learning more about these ideas and what to look for within each individual plan. All right, and that's the key thing, is have a plan to begin with. Decide when you're creating your plan, what is the objective of your trade? Are we looking at this for a shorter term move or more of a longer term trend move? What is our posture for the trade? Start by asking which way are the markets going? If the markets are going down and you're trying to find a stock going up, it might be a little bit more difficult to make money on that trade. It'll be hindered by the market. So determine beforehand, are we being bullish, bearish, or even just being neutral? What has to happen for the trade in order to be profitable? What is the target? Where do we look to get out of that trade? And then finally, what is the risk on that trade? And what is our exit strategy? Out of all this criteria, part of the plan, I believe the two most important questions would be the very last two. Before you enter into any trade, ask yourself, well, how much do I stand to risk losing on that trade? What is the worst case scenario? And at what point will I get out? By knowing that before entering the trade, then you won't trade emotionally. You'll be trading more mechanically. All right, well, I hope this information is helpful for you in showing you how we invest in stocks. Start there. And then by looking at these individual stocks, we can look at those trends and decide what might be working well for a potential option strategy. This also emphasizes the importance of using technical analysis, which we'll be discussing in another lesson.